Today is our pleasure to invite Mr. Gregory Benning and Dr. Jonathan Gertler from Back Bay Life Science Advisors to share with us how SPAC's vehicle help institutional investors reach their IPO investment target and help growth companies become public without the marketing exposure of a typical IPO process. We will start the section by having Mr. Gregory Benning, Managing Director and Head of Investment Banking at Back Bay Life Science Advisors, giving us an opening speech of current landscape of life science SPACs. Welcome, Greg.
Hello, and thanks for inviting us. And together with my partner, Jonathan Gertler, we're very happy to be here. In terms of a quick background on Back Bay so that the audience can understand our perspective. Jonathan and I have been around the life sciences, well, in Jonathan's case, all of his career, but in my case, about the last 25 years as an investment banker. Jonathan's background is in medicine and venture and as a life sciences entrepreneur, and mine is in investment banking. And I think the idea for Back Bay was that there were these various components of the life sciences development economy that would answer parts of the question about, okay, how do you position a piece of IP, a potential drug, a diagnostic, how do you leverage a team in terms of financing, what's that worth, and then how do you bring it forward? And what Back Bay does is about 80% of our time we spend on the strategic advisory side of things, figuring out what the right answer is for a company. It's a global practice. We work on about 80 projects a year. Our largest client is in Asia. Our largest geographic concentration outside of the US is in Northern Europe. We work with a lot of accelerators. So we're very much in this innovation economy. I think when you look at the public capital markets for the life sciences, and I think Jonathan will talk a little bit about how those have evolved. SPACs kind of popped onto the scene, generally speaking, in the US in the early 90s. And it was a specialty finance tool that was used to finance deals that were in sectors that were hard to finance. The first European SPAC popped up about 10 years later. But what you saw in the last 2 to 3 years was literally an explosion of SPACs. And just to give you an idea of the amount of money that's in play right now, in the life sciences sector alone, there were 70 SPACs. Some of those were generalists with an interest in healthcare, but another 50 were life sciences specific. The life sciences specific SPACs that are out there that are looking for deals right now came to market with about a $200 million average issue. So if you have 50 SPACs trying to put money to work over the next, on the average, 18 months, that's 10 billion of equity capital. The average de-SPAC transaction that they're chasing is usually 5 to 6 times the size of the SPAC. So you do the math there, and you're talking about prospectively 50 billion of M&A deal flow. And then there's another, the pipe financings that typically come along with the de-SPAC transaction is probably another 5 to 10 billion of underwriting issuance. So all of the sponsors that have put their money to work to promote SPACs need to find a deal or they lose that money. And the amount of deal flow that is looking for a de-SPAC transaction relative to traditional biotech IPOs, life science IPOs, is a really big amount of money. So it has a lot of attention of the street, the investment banks, the crossover investor community, and the venture community. And I'll pause there and let Jonathan add to that. But that's the amount of money that's in play right now over the next year and a half.
And I will, I'll pause, I'll make a brief comment and then certainly welcome your questions and further discussion. I think one of the things that has to be recognized about the SPAC phenomena, there's zero question that the sustainability of the vehicle has increased over what Greg and I have historically known over the decades that we've been involved in the life science finance sector. Ironically, early in my career, probably on an every 3-year basis, I would get calls from the press saying, when is the biotech bubble going to burst? Is the window going to slam shut? Are we going to have nuclear winter? And obviously biotechnology in the last decade, despite a few blips here and there, has become an extraordinarily sustainable part of our economics. It's clearly a risk capital transfer type of play. We know that each asset class assumes risk from the next, a different valuation based on de-risking, and carries it forward until final exit events and clear value proposition is proven. But it's a very sustainable part of the financial sector, with bumps along the way getting to where we are today. I think the SPAC phenomena could likely be viewed in a similar way. The concerns we all have about any robust market is that, and I think it was, it's referred to in some ways as the odd lot hypothesis, that with the last money that can come in is inevitably the money at the peak of the valuation curve, and then it's a highly risky business. And so you worry when capital is flowing at huge amounts that there will be corrections, et cetera, that will actually create a recession in the asset class that we're speaking about. I don't think SPACs are necessarily any exception to that. What it speaks to, which is also true of any IPO frenzy that can occur, and this is incidentally not just applicable to biotech, but applicable to health tech, applicable to med tech, is that the choices that need to be made on either side of the equation need to be made with extraordinary full diligence. And so essentially these are acquisitions of teams, acquisition of assets, acquisition of news flow, and the need for appropriate financing, appropriate valuation, and it's very importantly, appropriate street sponsorship going forward. So we can get into the details of the way we discern all of these things, but those are the caveats around what is at the moment an extraordinary amount of capital, as Greg has outlined, paired to an asset class of financial vehicle that does seem appealing for companies looking to leapfrog certain typical hurdles, but not necessarily done easily, and also certainly has to be done with extensive thought.
So I'm so glad you did really mention about there's a potential being like asked by many people about this bubble. So can you please, and also you touch base about this SPACs, and also right now how popular it is, but can you summarize your sense, you and also Greg, your sense, why this era of SPACs is so different? And also, do you expect this life science SPACs become a continuous presence?
Yeah, I think if you want to look at later stage venture, and you look at SPAC technology, and you look at the types of players that were investing in these deals through the second half of 2020 and the first quarter of 21 in particular, I think there was been a rapidly changing perspective, and the SPAC technology was starting to evolve. So, and as Jonathan said, there's a whole story of, okay, you've become the target of a SPAC, and then what do you do? Or how do you know that you're right to go public that way, and then how do you build a public company after that? But I think with respect to the venture community, and then I can talk a little bit to the entrepreneurs that are in the companies that are targets of de-SPAC transactions. I think they're sort of using SPACs as leverage versus the street, in that you can go in and you can negotiate valuation without the whole risk of the traditional IPO process, where you have to go in and get all the registration statements in place, and then you have to go out and do the traditional roadshow, and you're exposed to market risk for that whole period of time. So both in terms of valuation and execution risk, I think the VCs have been looking at the SPAC as leverage on traditional investment banks. On the flip side, the traditional investment banks get to do the M&A advisory and the pipe transactions, so they're perfectly happy to have that competition. But I think if you're looking at the VCs that qualify as crossover investors, and they're trying to say, well, how do I dollar cost average via a bridge round with a goal of evaluation in 1 to 2 to 3 years post IPO? There's been a big dynamics change in terms of the 20 or so US VCs, at least in terms of these US listed SPACs that are playing there. So I think, are SPACs really the new crossover investors? Are they willing to take strategic value risk versus market risk? Are IPO investors now the crossovers to strategic exits? Those are sort of the questions that are on the table. I mean, if I had to look at the new issuance in SPACs and what's been going on the last couple of months, you see the street tend to sell stuff until everybody's full, and they say, okay, I've got enough of that now. Let's see how it works out. So I think that what you've got going on right now is a little cyclical phenomena where there are a bunch of SPACs put in place, and now the investors are waiting to see what sort of deals those SPACs are able to put together. But yeah, I think everything that I just said, I think to some degree, part of what we're experimenting with now is, are we disintermediating traditional IPOs? And I think in healthcare IT in particular, that's where you're seeing some really pretty extraordinary valuations. Jonathan, I don't know how you'd add to that.
Yeah, no, I will, and so I'm gonna be a little bit of the voice of caution in this as well, and this despite the fact that I'm intrinsically usually optimistic about pretty much everything I interact with. But to go to the question about sustainability in the life sciences and to some of the issues Greg has spoken to, the trajectory in the IPO market, the traditional IPO market over the last decade, has been to earlier and earlier emergence as public companies, earlier stages, platforms with product perhaps in evolution, but not necessarily later stage clinical development, very high valuations, very large raises. My partner in a fund in which I'm a partner actually was present at then the largest IPO in NASDAQ history, which was Genetics Institute, and that was before biotech was even termed, and this was 22 years ago. That IPO was all of $90 million, and it was huge at the time. That's the average Series A, it seems, in Kendall Square these days. So we've had a migration to higher valuation, higher round, earlier and earlier risk transfer in the traditional IPO market. Health tech, which especially post-pandemic has attracted a great deal of venture infusion of capital and also a great deal of promise, is not quite playing in the prime time of IPOs without very extensive revenues. Livongo being an example of a very splashy health tech IPO, but it's certainly playing in the SPAC market to a certain degree. And the overlap between health tech, say, and digital therapeutics and traditional pharma is also playing there. Is it a sidestep of, when you're still being valued for technology speculation as opposed to actual revenue production? And is the danger, especially if you're a cost averaging mezz investor or a cost averaging VC coming into a SPAC round, that you will then get burned on the downside of a SPAC revaluation once reality hits there? I think it is. I think it's there very much so. And so on the one hand, I applaud the vehicle because it allows for efficient funding of companies where much more capital is needed and much greater risk capital is needed, and sidesteps the traditional process. On the other hand, when there's a seller's market, a de-SPACers market in play, and the valuations may exceed what can rationally be supported by the street and can rationally be supported by company performance, then I think you run the risk of correction and a devaluation of the asset class at the expense of some very strong companies and strong SPAC concepts that really should be supported. Those are my concerns in this dynamic. Do I think it's sustainable? Yes, but as always, I think things are sustainable only when they're responsibly handled.
So now regarding the way life science SPACs, how they set themselves apart from generally the SPACs, can you expand on that part? Can you just discuss more about that part, and also what do you see as the best practice in terms of the target transactions?
Yeah, well, I think at a high level. So if there are, if there are 50 SPACs that are out there chasing healthcare companies and assets. There's a group of them that are generalists that say they'll invest in healthcare. And then there are the life science SPACs, okay? And I think the key differentiator between the two is the scientific committee and the screening process that they use when they're looking at investments. So if you're investing in a pure life sciences SPAC, I mean, those tend to be a little bit smaller in terms of issuance size, maybe 150 million. But what you're really, as an investor, placing your bet in is, in turn, that scientific committee and that board's and those independent directors' ability to pick a smart target. So you know, if you're an institutional investor and you're spreading your bets, it's sort of like you're placing bets on people that are going to then make your bets for you. If you're a retail investor, you know, an individual investor, it's a much more concentrated kind of a thing. But we were on a panel not too long ago with 3 life science SPACs alongside us, and it was all about the investment process. It was all about how do I go about picking the right company, you know, in terms of, okay, how big can this be? What's the risk profile of it? What's the news flow going to look like? How do I get street coverage? How do I build an investor base? You know, who are the investors that would come into this company if I did this deal versus that deal? And they were very much focused on both science, but also, you know, is that company, you know, ready to be a public life sciences company? And I think some of the generalist ones are, you know, a little bit more, and they may dabble a little bit more in the health tech and AI side of things. They may be a little bit more momentum oriented and a little bit less focused on the end markets. But the real life sciences SPACs really understand the science. They understand the unmet need, what the clinical risks are, what the adoption risks are, and also, is this company going to be able to generate enough news flow to support a public market cap? Jonathan.
Yeah. So let me extend from the life sciences into the 2 other areas in healthcare, specifically medtech and health tech, a little bit to further answer the question as well. And I will say, you know, Back Bay's raison d'etre, as Greg described earlier, was that every transaction needs to be supported by extensive diligence, and merely running a process or you know, or dealing with it as a real estate transaction is just not acceptable across all of healthcare. The regulatory, pricing, reimbursement, adoption hurdles, buying issues, quality issues, cost issues, et cetera, are so complex. And our reason to be is really to provide that strategic diligence and then execute on the transaction to follow. And I think it is an analogous need in any market. The IPO market is probably, because of the vetting process, a little bit different. In the SPAC market, it's absolutely essential. If you look at, let me start with medtech for a moment to expand on, you know, for example, the categories there. I tend to categorize medtech into 4 categories. There are the absolutely disruptive technologies that can change the way medicine is practiced without any precedent whatsoever. At the time catheter-based cardiovascular procedures came out, which was early in my cardiovascular surgical career, that was a huge game changer. For the most part, now they're just incremental adds. But back in the day, they were game changers, and they had that biotech valuation and biotech risk associated with them. The next 2 categories, both of which I think are highly investable, are either marked improvements on a quality and delivery basis of established medical principles, or alternatively, using engineering principles and translating that into a medical field. The latter is a little bit more difficult, and it has every need to make sure that the problem being addressed is truly unmet, and it also has every need to ensure that you actually can get adoption, and therefore likely has more of a commercial hurdle before it is fully accepted as a liquidity event. The clinical translation tends to be predicated on well-known principles with regard to adoption and reimbursement, so it's a little bit of an easier path. And say the 4th category is just an incremental cost or quality game, which isn't germane to this discussion. In health tech, and then I'm going to come back to SPACs after this sort of overview. In health tech, what I see over and over again are companies that have extremely interesting solutions for streamlining care, managing data, managing information, facilitating patient care, et cetera. However, often very little thought is given to how to integrate that into the delivery of care, and especially in the United States market, which is increasingly consolidated, increasingly controlled by one of 4 electronic medical records, part of diversified integrated delivery networks that have numerous hub and spoke types of approaches to healthcare. And in the absence of that translation to adoption, you can end up with an elegant engineering solution and absolutely no place to go. The danger in the health tech and the med tech SPAC is that you can go down the wrong path and take out a company with too much money too early when it hasn't proven those adoption hurdles. The benefit of them, and I think this is very, very interesting, is say in health tech, you have solved those problems, but you need the scalability that only capital will provide you. SPAC is a very, very compelling vehicle as long as you have that story straight and you know the steps ahead. And in med tech, perhaps you can, unlike the traditional med tech IPO, which is a revenue and even EBITDA driven event, maybe you can actually take some of those disruptive technologies that still hold great promise and predicate it on the right due diligence and the right predictability of the clinical trials and animal trials to date, fund it, and end up with a great return because you've actually backed the right disruptive element. Those are the things that can be fascinating about the SPAC world in terms of how healthcare is differentiated, but it's all predicated on this exceedingly deep dive that covers everything from technology right through to the last mile of adoption hurdles and reimbursement.
So then the follow-up point is, what are, in your point, some of the clearly differentiated strategies that you see from various life science SPACs?
Well, I think there's a range of things. I mean, one of the larger ones, Nuvation. I mean, the CEO who was the guy behind Medivation, which had a great upward trajectory. One of Jonathan's old war stories is we had an opportunity, 20 years ago to do a PIPE transaction for that company when it was, I don't know what, Jonathan, a couple $100 million market cap or something.
Actually, like the first PIPE, the Medivation, was about 35 million, I think, and the second PIPE I did with them was, I think, 110 million.
I think
and David did it from 11 billion.
Yeah. So Nuvation, I mean, he looked at it and he said, okay, here's an opportunity between the SPAC and the PIPE transaction, an opportunity for me to just stay focused on development and not have to go out and spend all my time raising money 3 different times. So I think that is one perspective in terms of accelerating the ability to aggregate capital. I think the other thing, and it goes to a question in the data room, is the idea of being able to get around the restrictions of an S1 in terms of guidance and use of projections. And if you want to compare and contrast an IPO perspective with some of the SPAC management presentations when these deals get announced, the use of projections is pretty extensive, and another way of saying that is, in a traditional IPO, you're not allowed to talk about stuff that's speculative. It's basically like, here's the company, here's the capital structure, here are the markets that we're in, and here are our risk factors. There's nothing about why is this going to be a good stock. And SPAC sponsors have been able to be much, much more aggressive in terms of putting that story out there. So, in investment banking, humor, one of the things that's kind of funny is if you go to the back of those presentations, there are literally anywhere from 7 to 10 pages of bullet points about risk factors. So there's a 50-page presentation. The first 40 pages of it are all talking about how great the company is going to be, and then the last 10 pages tell you about what could go wrong. So they've been fairly aggressive in terms of pitching stuff that, if it's a biotech company, I mean, when you get to the end of that trial, either you're going to meet the endpoint, you're going to not meet the endpoint, or you're going to get data that tells you that you need to go get more data. And I think with respect to drug development, the truisms are there will be setbacks, it will take more time, and it will take more money. I think that as the SEC looks at these things, and compares and contrasts to traditional IPOs, and you look at hot IPO biotech classes and how many of them trade down while they're waiting for news, and then they, you know, if their lead asset doesn't meet its endpoint, they blow up. I think that the SEC, from a political standpoint and public policy standpoint, is going to continue to put these things under a microscope and be increasingly demanding on SPAC sponsors. And to the question, if I understood it, about SPARC, which was the deal structure that Pershing Square put out in its proposed transaction for Universal Music. Bill Ackman just pulled that deal off the market a week ago because the SEC was coming back to him and giving him a fairly thorough critiquing of some of the structured finance aspects of that deal. So, I think that SPACs, is it a financial engineering tool? That's a question that's on the table, and I think that until this class of SPACs gets invested and you start to see some clear winners, I think that that's going to be something that sort of, puts some pressure on getting too different from traditional IPOs.
Greg, I didn't know there was a category of humor known as investment banking humor. I just, learned something on every panel. So, one of the things I think that's also,
I always like 10 pages of risk factors.
They can be, you're right, it's some of the best light reading there is. So I think, another thing to mention strategically, and I think this is less true of the biotech SPACs, and I think potentially more true of the health tech SPACs and the med tech SPACs, and maybe even those that extend beyond classic clinical medical plays into some of the, the wellness plays that are out there, et cetera, that have also been, part of some very splashy events in the public markets, that it does create a currency. And in med tech, especially, and if you have a disruptive technology that you're developing, but you want to be able to layer in revenue generating companies that haven't had the scale to get there, SPAC vehicle with a public currency with proper capitalization can give you the means to jumpstart, again, past what your core value offering is at the time of the SPAC into creating a larger entity. This is always true about going public as well. It's certainly true in health tech, where you might have a managed care platform in cardiology and elder care and diabetes, and yet that technology actually has legs to go well beyond the vertical that has gotten you de-SPACed. Suddenly you have currency that you can't really get in the private markets. You have hopefully a freer trading currency, so liquidity is less of a pressure, because for private investors, the timeline to liquidity becomes a higher pressure. And you're able to build with greater speed and greater facility because of the capital than you would be necessarily in a private setting, or even for that matter in a private equity setting, which has different restraints to it. So again, a positive of that, the flip side, and I'm a broken record, is that if you don't diligence the fit properly, if you don't diligence the trajectory properly, as an investor, you can get burned with down trading. And as the buyer or the aggregator of these entities, you can end up having spent a great deal of money or a great deal of your equity currency on something that actually never really has legs in the market. And those are, I think, even more so than biotech, which tends to be platform driven to product, product execution, where aggregation is less of an issue perhaps than it might otherwise be.
Yeah. I just realized actually before I start, I didn't really get a chance to introduce Dr. Jonathan Gertler. So
okay.
yeah, so if I can just really quick also to bring that information. So Dr. Jonathan Gertler, he is a managing partner and a CEO at Back Bay Life Science Advisor. And he is also the founding partner of Bell Ventures MedTech fund.
Actually, not the founding partner, but a managing director there.
Managing partner, okay. And he also have 30 years of clinical and also scientific experience. So I just want to also bring, so probably many of the audience can tell, actually Greg and Jonathan are coming out from very different perspectives. So yeah, just want to also mention that. So actually, next question is, what does IPO rate mean in 2021 second quarter? And what is the difference? You mentioned a lot like previously about the PEP and also street support, but what is really the dependence on PEP and the street support versus approvals? In other words, between private versus public.
Yeah, I mean, one thing with, so you had a whole bunch of SPACs come public in 2020, and then they go find their targets, right? But while they're waiting to find their targets, there's a bid and there's an ask on any stock trade, right? So on the bid side, you know, you got the natural investors and the passive investors, and on the ask side, there are, you know, active investors and, you know, and things that are attracting people. But so you went out and you have this 10 billion of capital that has basically been pushed into probably a fair amount of generalist accounts. Although, you know, there were a decent number of VCs playing in there, and I think those ones have held up better. But, you know, when shares come on the market, okay, how do I find somebody to buy those? And if you don't find somebody to buy those, then the stock drops, right? So I think that the investment banking industry was pushing all of the SPAC volume out there during 2019 and 2020, and it got really hot in 2020. And everybody, you had these buyers on the margin that were buying SPACs because they were hot, and what's a SPAC, and, you know, things were trading up. And as soon as the trading desks on the street were not able to find the next buyer, that stalled. And I think what happened was, you know, like I said, markets are cyclical. I think that there was enough new issuance volume that the people that really wanted to own the things for the right reason had bought all they wanted for now, and that the generalists and the momentum investors and the speculators, as soon as those stocks started to go sideways, stopped buying. So I think you've seen some general pressure on SPAC prices, you know, over the last several months. And when the SPAC indices as a whole are trading down, it's very difficult to issue new SPACs. So
Greg, you're probably better equipped to comment on it than I am, but also the issues around the way the SPAC investors, the original seed investors in the SPACs, really then have their structure has been altered really over the last few months as well, right? Which will diminish the enthusiasm for floating a SPAC in the first place.
Well, also, but the early deals where the investors might have been getting more economics than the later deals.
Right.
You know, if you're sitting there and you're you're working on a desk and you've got a half a dozen so you're one of the big banks, okay, and you've got a dozen SPACs that you're taking care of, and you've got a certain amount of share volume coming up across all 12 of those issues, and you're talking to a broker who says, okay, my client wants to buy some SPACs. The ones that have sponsor economics that are older, right, which are more generous to the sponsor, you know, are not going to be the ones that somebody necessarily says, okay, you should buy this one. So I think you've seen pressure on these aftermarket prices while people are basically waiting to see the deals that they invest in. And if the deals are well recognized and they're not overpriced and the stocks trade up, and then there's some near-term news flow that drives them further, those sponsors are going to be back issuing new SPACs. But the ones that can't put the money to work well, you know, I think a lot of them are going to be one and done.
And there's a question in the feed, you know, keying off, I think, the comments that you and I both made, which is, you know, will there be a buying frenzy by SPACs looking for assets, and will they, you know, really not have enough mature assets to reach to it? It may be mature, it may be quality, and I think that really speaks to what Greg just said. What will drive this market sustainably, and that may be with a correction, you know, it often entails a correction, is that we can see that the money gets deployed. It gets deployed into justifiable de-SPACing transactions that are done at valuations that are at least within reason. And then there's a subsequent trajectory, not only because the pipe that is done at the time of the de-SPACing is successful, but that the sponsorship by the banks and the analysts are there because the thesis of the de-SPACing event is sound, and then the performance continues. And I think if we see enough of those, as Greg was just alluding to, then you have sustainability in a financial sector. I think what we saw historically was that these were vehicles oftentimes of convenience for distressed assets. People took flyers at them, and then they receded because they weren't very successful. You know, an analog, and it's a lot less clean, is the reverse merger story. I mean, you know, there are periods of time when there are large, you know, rapid IPO windows. Companies go out, they're binary events, they crash, they're trading below cash. You then have to go ahead and do a reverse merger. Historically, reverse mergers have not been particularly successful. Medivation, Greg mentioned earlier, was a resounding success, but it was in the minority of companies that were founded based on a reverse merger as public companies, and then were able to accelerate. And that's because David Hung and Lynn Seeley and Pam Ashada, the team that was there, really did a terrific job of, you know, generating assets, generating news flow, and most importantly, actually getting good clinical results from their trials. But most reverse mergers didn't really work well, because there were, you know, there were distressed assets, the news flow was poor, there was zero sponsorship. And once you get into that microcap purgatory, it's hard to break out. SPACs don't have the latter issue, but if they have the issue that they are not proving to be fruitful for their investors because of actually having a quality platform that then accelerates into success, you'll see a pretty meaningful correction across the space.
Yeah, now let's go from life sciences back over to healthcare IT and some of these AI plays.
Yeah.
And one of the arguments, you know, by some of the more aggressive SPAC promoters are that this democratizes IPOs and it gives the little guys a chance to participate with tier one investors, right? So if you have you know, an AI play focused on healthcare IT, that the very best crossover investors and the very best VCs are all coming into, that they're in, some of them are in it in the de-SPAC and some of them come in the pipe. And it's just a paradigm change, and it's something that, you know, it really is a better IPO than the traditional IPO process would put together, just because those smart investors agree it's the right way to go, and they don't have to go through a traditional investment bank to tell them what the answer is. Then, you know, okay, that works. But there's so many SPACs out there that you're going to have examples of things like that. You're going to have examples of biotech deals that make really good sense as a SPAC, and you're going to have a bunch of people, you know, doing deals that probably shouldn't be getting done. And it's going to be a mosaic, so it's going to be a complex picture.
Hey, Greg, there's a question also, and Ella, in the feed about what happens as the SEC puts more and more regulations around, you know, need to report and, you know, to stand by projections, to be more granular, et cetera. And Greg and I have been joined at the hip for 20 years with finally both of us meeting in the middle, but his with his corporate finance background and me with my clinical and scientific background. So I'll defer that question to him, but I guess I would just say a rose by any other name would still smell as sweet. Ultimately, if you get more and more regulations, the SPAC is going to look more like a traditional IPO with maybe some minor variations therein.
Yeah, I mean, Alex, I think the class action lawyers, you know, look at the SPACs as 10 billion of cash just sitting there. So in some cases, they're going to sue just because the money's there.
Willie Sutton's law.
So this is a really great point. So a follow-up question for that is, can you share some, since we're on this topic, can you share some lessons you learned or some advice you want to give from regarding positive or what not to do when it comes to the life science SPACs from your own perspective, from investor or legal's perspectives?
Well, yeah, Greg, why don't I start on some of the things we're seeing in companies that we've worked with as they contemplate a SPAC route, and you follow up with some of the regulatory and legal issues. You want to take it in that order, or the reverse?
Up to you.
or up to you. After you, Alphonse. No, after you, Gaston. So the in terms of companies and lessons that we've learned, it is really, it's no different. I think the same principles have to apply. I mean, we are extremely quality and depth driven in the way we approach companies. I'll give an example that is an hour old. I was just on the, and Greg was with me. The two of us were on the phone with a European company in a very novel space, very well funded, extremely prestigious board, et cetera, talking about, some of the issues around cross-border IPOs, coming from Europe or any other region for that matter, but this was a European company, into US NASDAQ. What does that entail? How do the MES rounds work? What's the best way to approach US investors who may want to cost average into the IPO? But the fundamental discussion is the one that we have over and over and over again. And it has to do with, what is the platform's strength and differentiation? What is the indication prioritization? And this is very specifically biotech I'm talking about, but it really is applicable across other fields in many ways. What is the indication prioritization? What within your portfolio is something that is feasible to prove the platform and prove clinical development that is appealing, but incidentally not so small or uninteresting a market that it doesn't really move anyone's needle? For that matter, what's an indication that might be extremely appealing, but where the competition is so intense and the regulatory pathway so deep and so costly that it's not in your interest to do so? What are the programs within your portfolio that are better in other people's hands, that are out-licensable or partnerable, and in the same tone can validate your platform without having you incur the expense? And even though it's dilutive in the long run to partner, and the short run, if it accelerates your value, can be extremely appealing. And that entire range of conversation and question, and including, incidentally, and this is extremely important for any company, don't just go to those people that are enthusiastic about you. Don't just go to those people that have endorsed you or working with you or are interested for their academic or clinical reasons to endorse you. Go to the naysayers, control the debate, know exactly what's going to come up that's negative in any process. That discussion around IPO, that discussion around M&A, licensing and partnering is exactly the same conversation that you should have around a SPAC or a de-SPACing event. Greg, do you want to comment on some of the legal ramifications we're seeing in terms of either the cross-border challenges or whatever? Or have we exhausted this subject?
Well, I mean, one question was around, well, what happens if from a regulatory or a legal standpoint, things get tightened up in terms of ability to use projections or the ability to go back at people that use projections. I mean, I do think that, the independent directors of a SPAC are not the long-term directors of the de-SPAC company. So I think part of what they're trying to do is present things in a responsible way, because if they don't exercise their fiduciary, I think they've got a higher liability profile. So it's tougher for that group if that stuff gets put under scrutiny. I mean, I think in terms of, if you tighten up the ability to use projections, does it impact SPAC issuance? From a frenzied standpoint, yeah. But if you look at this as the new crossover investing, and you say, okay, there are these institutional investors that are going to be the key investors in the SPAC. So the SPAC IPO is really an institutional IPO with a little bit of extra money on the side. And there are enough of those investors to approve the de-SPAC transaction and to commit to following on in the pipe. So can you get the SPAC floated, and can you do the de-SPAC transaction, and can you do the pipe? Yeah. But is your ability to tell the story of the de-SPAC transaction? I mean, you've got this one shot, in the announcement of the deal. But once you're a public company, you can't do that anymore, and you're subject to much tighter guidance and disclosure regs. So I think it would make it a lot harder to build that long-term shareholder base, and eventually the VCs. I mean, maybe they're looking at it and they're saying, okay, it's a bridge to a strategic exit, and you have some key de-risking, or you have some key commercial things, and then the company goes IPO, and then 2 to 3 years later it gets bought by somebody big, right? So in that scenario, fine. But in terms of if you're looking to an eventual exit via the public markets, I think that gets tightened up quite a bit.
Well, okay. We have 8 minutes left, and we get some questions Q&A from our audience. So who want to answer those? We got a question from Neil Ray also.
Yeah, I think I covered.
I think we've sort of addressed. Yeah, and the frenzy question, I think, Ella, we've also covered, which is this issue of mature assets and quality assets. I do think that SPAC sponsors will be nervous if they aren't able to de-SPAC, and so I think at the moment, especially if you look at some of the valuations, there is a little bit of a seller's market that we're seeing, and I'm certainly aware, without naming it, of several de-SPACing events for companies that were in the private markets looking for private capital at fairly steep valuations that hit some roadblocks based on as I alluded to earlier, the type of discipline and exit horizons that private investors have to exert that may not be in concert with the capital raised to date in a company or the valuation that it's achieved through whatever financing sources it's done so. In a couple of those settings, I've seen companies be the de-SPAC target at very wonderful valuations for them, and I'm delighted for them, and I wish them the best now with all the new capital that they have to really be able to execute. And then in that setting, the SPAC vehicle created an opportunity at a valuation that you wouldn't have seen in the private market. So I think with the amount of capital there and the amount of assets that they will have to look at that are quality assets, there may be a lean toward the de-SPACing target that is advantageous to the de-SPACing target, and that's also something that will inform in SPAC investors. Sorry, Greg.
That's not to say, and there was one deal in particular that we were talking about in our internal team meeting where it was one where we had seen it strategically and we'd seen it in the financing market, and the SPAC valuation was higher than we thought it was worth and higher than we thought it could get financed at. And Jonathan and I, one of the first projects we worked on was a dual track. It was a small public company. It was worth about $300 million, and we were working on a dual track pipe / M&A thing where we were out talking to the strategics, but we were also talking to pipe investors. And the pipe market was better than the M&A market, so the company financed, right? So, that SPAC that's doing the deal that we're commenting on, and eventually that 300 million market cap turned into like $1.5 billion market cap. So, there you go. So that SPAC could work out. But it is something that when somebody sees a SPAC deal getting done, it would be kind of like, well, okay, you have to be able to answer the question, did you look at traditional financing options, and did you look at at strategic options, and why does the SPAC deal make the most sense? And there are situations where it's like you look at it and you go, yeah, that made a lot of sense. And there are other ones where you look at it and say, you did that because there was incrementally more liquidity for selling shareholders, or because the valuation was higher, or whatnot, or because somebody had to get a deal done, or they were going to lose their sponsor economics. So I think you're certainly going to see deals that get done that are not good deals, and the market will deal with them accordingly.
Wonderful. Last question, what is the best way for our audience to find you if they are very interested to go through SPACs?
You can find us through our website. So it's so we're Back Bay Life Science Advisors. So it's bblsa.com. In the resources section of our website, there's also a link to another SPAC panel that we did not too long ago that focused in on some of the same stuff that we touched on today. But we had, like I said, three SPAC sponsors on the call, including Bain Capital and LSP, which did a NASDAQ listed SPAC focused on European targets, which was a pretty interesting angle. Because generally speaking, our view on Northern Europe is that there's a lot of really good intellectual property over there and a lot of really good product development, but the life sciences investment market is nowhere near as big as it is in the US. And then we also had one of the larger law firms that specializes in SPACs on the call. So that's an interesting listen if you've got time. But yeah, bblsa.com and you can reach us there.
Right. We have just a contact form on the website, which is info@bblsa.com, and the team members were all listed there. Everybody is listed on the website, and we'd welcome outreach and questions. And Ella, let me also just say on behalf of all of us at Back Bay, we're so delighted to be working with you directly and to have been a part of this very interesting series that you're putting on, and really truly appreciative of the chance to do that.
Thank you. Thank you so much, Greg and Jonathan, for your excellent sharing. And also myself learned really a lot from today's talk. And I also truly believe our audience also find today's topic extremely valuable. Thank you again for your time, and I'll hope to see you in person soon.
We can't wait. Thank you so much for letting us be a part of it. Take care. Bye-bye, everybody. Thank you.